I'm going to present you my master thesis about the impact of ESG on corporate financial performance in the European banking sector. The presentation is structured into 5 main sectors. The introduction introduces the scope of the research. The literature review is where previous studies were examined. The methodology outlines the research design, data sources, and analysis techniques. The results present the findings and analyze their implications. The conclusions summarize the key insights, acknowledge limitations, and suggest directions for future works. In today's interconnected global economy, the definition of corporate success has expanded. Companies are now judged not only by financial performance, but also by their commitment to environmental and social responsibilities. This shifts companies to set objectives that go beyond profit maximization and contribute to the greater good. Businesses are increasingly valued for their role in addressing global challenges like climate change, social inequality, and ethical governance. Environmental, social, and governance, the ESG framework has become a critical tool for assessing non-financial metrics and understanding the broader impact companies have on their communities. ESG has become especially influential in sectors foundational to economic stability, like banking, which serves as a backbone for sustainable growth and development. For banks, committing to ESG is not just an ethical choice, it is essential for fostering long-term economic resilience. Furthermore, it foments transparency, responsibility, and integrity. My thesis investigates a central question: does the integration of ESG initiatives have tangible value to companies? Especially, it is focused on examining the impact of ESG on corporate financial performance, analyzing the holistic impact of ESG, and exploring how each of its 3 pillars individually correlates with financial performance. Sorry. To conduct a systematic literature review, this study utilized the Scopus and Web of Science databases. I use a search algorithm with the keywords and gathered 823 publications. I then applied the filtering process by excluding articles not aligned with our thematic focus, language criteria, book chapters, and removed the duplicates entries across the database, yielding a refined set of 144 unique articles. Out of these articles, I conducted a focus analysis on 30 articles for their higher relevance to the study's objectives. The ESG framework defines essential areas companies must focus. ESG is increasingly recognized for enhancing business growth while addressing ethical, social, and environmental responsibilities, which are critical for long-term viability. Some insights I gained from the literature review was that corporate environmental responsibility reflects a company's duty to mitigate its environmental impact. Although critical for position environmental performance and corporate reputation, it can require significant investment without immediate financial return. Corporate social responsibility addresses a company's social and ethical commitments, from employees' well-being to community support. Those practices help shape a company's image and can enhance its appeal to society. Corporate governance focuses on fair and transparent decision-making that align with company goals and stakeholder interests. ESG considerations play a crucial role in investor decision-making, influencing investment strategies, portfolio constructions, and risk assessments. Superior ESG performance correlates with increased market valuation and can enhance investment outcomes. The findings obtained from the studies were mixed, as some of studies said that ESG had positive impact on corporate financial performance, while others said that there was a negative impact. This happens also for the 3 pillars of ESG. Through this analysis, it was possible to see that there are still several doubts about whether ESG practices really benefit corporate financial performance. That said, it was necessary to focus on a sector and examine it. My thesis comes to clarify this impact through improved models that analyze each ESG score individually. The literature review helped me establish the aspects to be analyzed in this thesis. Firstly, we intend to study the impact of ESG practices have on a corporate financial performance. This will be done by analyzing the ESG score as a whole and looking at the effects it has on the financial performance. Second, making this the first hypothesis. Secondly, we will analyze individually the impact that each ESG pillar has on the bank's performance. For this purpose, the environmental, social, and governance scores for each pillar will be used, being the three other hypotheses. I used the Refinitiv database to obtain information on ESG score and financial data on each bank. And as this thesis is about studying the banking sector in Europe, several countries are involved. So the Eurostat database was used to acquire information on each country's macroeconomic indicators. The data set used was subject to some criteria, including that they had to be banks in Europe with at least the last 5 years of information. This means that they needed to be active and have ESG data and financial information from 2014 to 2022 for at least 5 years. The period in question was chosen taking into account the ratio between the information available per number of banks and number of years. After filtering by excluding banks that did not meet these requirements, a sample of 84 banks was obtained. These banks are spread across 21 different European countries. Passing to the model, econometric models are powerful tools for exploring the quantifying the relationship between different economic variables. This model combines economic theory with statistical techniques to assess the impact of ESG. The model will be divided into 10 regressions that have the same aspect. Two types of dependent variables were used. First, the return on equity was used as an indicator of financial performance as it provides value insights into how effectively a company is using shareholder funds to generate profits. Its value is measured by the ratio of net income after taxes to the bank's average total equity. This is followed by the return on ROA, the return on assets, which is usually used as an indicator to study the operational performance of firms. This is a key financial metric used to assess a company's profitability and efficiency using its assets to generate profits. It is a short-term indicator that takes a company's debt into account, and it is measured by the ratio of net income net income after taxes to the average total assets. For independent variables, since the Refinitiv database provides two different ESG scores, I analyzed the difference between these two scores. Also, the first ESG score is characterized as the score based on information provided by the banks themselves regarding the three pillars of ESG, while the ESGC combines that scores with the controversials that might have been occurred in year for each bank. According to Refinitiv database, the environmental pillar measures the company's impact on natural systems. The social pillar measures the capacity that banks have to cultivate trust and loyalty among its workforce, customers, and society, and the governance pillar, how good bank system and process work. The control variables are indispensable components in statistical analysis. This said, in this thesis, nine control variables were used, of which 6 are related to specific aspects inherent to each bank. The size, the loan growth, deposits growth, liquidity, leverage, and capital adequacy ratio. And 3 are macroeconomic variables, the gross domestic product, inflation rate, and unemployment rate, representing the environment in which bank operates, the economic conditions. The panel regression data modeling was used as it combines the strengths of cross-sectional and time series analysis, cross-sectional units being the different banks, and the time periods the data used from 2014 to 2022. A fundamental distinction in panel regression analysis concerns the nature of heterogeneity between units. Fixed effects model assumes that an observed unit's specific characteristics remain constant over time. In contrast, random effects models treat these unobserved characteristics as random. In order to define which type of model is the most appropriate, I use the Hausman test. After that, it was necessary to test the model. For that, I submitted the model to a backtesting process. For the results, I'll start by analyzing the descriptive statistics. As we can observe, there is a slight difference in the values presented between ESG and ESGC due to the additional information that ESGC takes into account about the controversies. This caused ESGC to values to be lower. Based on the results obtained in the Hausman test, it can be observed that random effects were used for all 10 models, as the p-values were lower than typical significance values for alphas greater than 0.01. For the backtesting, the models passed all tests. So then I analyzed the regression results. For the model results for alphas equal to 0.05, ESG and ESGC have a slightly positive impact on return on assets and show a stronger positive impact on return on equity. The value of ESG differs from ESGC. This might suggest that it is indeed necessary to take these controversies into account, as it may demonstrate a score closer to the real value that a company should have regarding its ESG score. Environmental pillar have no significant impact on ROA or ROE. Typically, these types of investment are long-term, so their return is delayed. Social pillar has no significant impact on ROA, but a positive and significant impact on ROE. This comportment suggests that social pillar affects the profitability of the company in terms of shareholders' equity, but does not significantly influence the overall efficiency of asset utilization. The governance pillar has a positive influence on both ROA and ROE. These practices directly equity levels and also the efficiency of asset utilizations. Overall, the analysis indicates that companies that invest in sustainable practices are likely to see enhanced value creation over time as they adapt to evolving market demands and regulatory environments. This underscores the importance of viewing ESG investments not merely as a cost, but also as a strategic initiative that can drive sustainable growth and profitability. This thesis investigates whether banks benefit from adopting ESG practices by examining their impact on corporate financial performance. Strong performance in ESG, especially in the social and governance dimensions, reflects a bank's commitment to engaging with its stakeholders. For example, social initiatives can improve employee satisfaction and retention, foster customers' loyalty, and enhance community support, while governance practices such as transparency and accountability bolsters investors' confidence, attracting more capital. The significant positive impact of ESG and ESGC's social pillar and governance pillar on ROE underscores the importance of incorporating ESG metrics into investment decisions. ESG-focused investing can also mitigate risks associated with environmental liabilities, social controversies, and governance failures. This thesis presents important implications, offering practical insights for banks, managers, and boards of directors on adopting and disclosing ESG initiatives to enhance financial performance. The benefits of implementing these initiatives are substantial. For the thesis limitation, there was a notable difficulty in finding data that met the requirements. There are still challenges in obtaining ESG-related data, possibly due to a lack of transparency from the banks on these aspects, or perhaps because it is a relatively new and expanding topic. For future works, for future research, it would be beneficial to analyze each ESG pillar individually, components to pinpoint which special elements most strongly influence financial outcomes. For example, the definitive database rates each ESG pillar based on multiple subcomponents, and the close examination of these components could reveal which aspects, such as waste management or employee relations, are most critical to the financial performance, offering a banks a more tailored approach to enhancing ESG impact. Thank you.